All right, so we are here right now with and have the pleasure of speaking to Bradley Donnelly, who is currently a mortgage broker, been actively doing this for 12 years, also has a past history that we're just finding out of broadcasting, and also you said in the insurance business as well.
Yep.
So we are super excited to sit and talk with you, Brad, and just kind of learn and get some insight about the market, because you were talking about the different market shifts you've gone through.
Yeah.
And maybe I think a great topic would be at some point to get into where you think it is going to be going too, because I love to talk about that, just to figure out, just to help people understand a little bit where the market's going, because there's so many different opinions out there about things are going to crash or this or that's going to happen. So that's what I think we should get into
and
today.
I think a lot of people will want to hear about that too, where you think like prices are going to go, just from because they hear from us realtors all the time, and there's so much of that, so much videos that I don't think, like, for the mortgage broker standpoint, it'd be nice to hear from you. So we're really looking forward to this. Super pumped. And Brad's been doing mortgages since 2012. So he's been around for a minute.
And then some.
The silver fox over there. He's ready to rock and roll.
So Brad, I guess let's start off with a question for you. In the 12 years that you've been doing mortgages, I guess what are some things that you've learned, some wisdom that you'd want to pass through just to people that may be looking to get into the market? Let's say first-time home buyers or people that are like trying to figure out what they should do with like remortgages and stuff. Like just with your experience over the last 12 years, like what's I guess the question is, what do you think people should do coming up? I want to get right into the predictions. Yeah, Where do you think the market's going?
Yeah.
Yeah, let's just do that.
Let's burn right into that. So we were lucky enough to go to the national conference. We spoke to a lot of the chief economic.
Where was that?
In Toronto. So, Canadian focused, what's going to happen in Canada, and, not just what's happening in Toronto, because everything is kind of geared, all the media is geared to the GTA, to the Toronto market. But at the end of the day, how's that going to affect us in the Maritimes? How's that going to affect the guy out in the prairies and that type of thing? And we talked to a lot of the chief economic officers for some of the bigger banks and some of the big wealth management companies. There were a number of different speeches and presentations, and the overwhelming sense I got is we're over the worst. Like we're over COVID, we're over the spikes in interest post COVID. Interest rates are now, they would have peaked in October basically of last year.
Okay.
So all of the big thinkers are saying, hey, look, rates are going to go down, but they're not going to go down as fast as everybody thinks. Right. Everybody thinks, oh my God, they're going to go back down to COVID levels. It ain't going to happen. Right. You'll never see COVID levels again because the federal government has put in so many new little nuances into the B20 Banking Act that you're never going to see interest rates 1.84 again, ever in your lifetime.
What's the B20? What's B20 mean?
B20 is the Banking Act, which is legislated through the federal government. So we follow a number of different legislated rules and regulations. Right. We can get into that later on because a lot of clients will ask us, well, why do we have to do it this way? Why do we have to do that? Because we have to follow the rules. We have to follow the rules, the regulations, and the laws. And we're not only administered by the federal government for mortgages, but we're also administered by FCNB. That's our provincial, like FCC, like your economic securities, commission.
Right, which we fall under as well, don't we?
We do, yeah.
Yeah, we follow under that guardianship, or basically they're our overlords. Okay. So we have to follow their rules as well. Yeah. So as far as rates are concerned, I mean, everybody is saying, all of the big ones, all of the big thinkers, and a lot of people in our industry, brokers that have been around for 10, 15, 20 years, are all saying, we hit that curve and it's going to start going down. How does it affect the rates? Well, if you were, in my opinion, based on having hundreds of conversations with clients and with brokers and with bank economic advisors, I think that we will see the fixed rates go down probably 1% to 1.5% from where they are right now. So let's use the example. So if you were to buy a house in October of last year, your best 5-year rate was 5.89. Mm-hmm. Okay. Today, your best 5-year rate is 4.99.
It's down to 4.99 right now?
Yeah.
Wow.
And we figure that by June, July, we'll be in the low 4s, high 3s. And that's where it
By
should
June or
settle.
July.
Yeah, it should settle in around there.
If that happens, things are going to get a lot worse for buyers.
I would say that in February of this year, like this month, once we got into that 4.99, 4.94 range, it has opened up a lot of opportunities for people wanting to list their houses, because it's a psychological thing. We're out of that 5% range. Now we're in that 4% range. Now I can list my house, and I don't have to worry about having to have a high interest rate if I buy another house.
I'm going to make some money.
Yes.
I can get into the house I want,
right,
and have a decent payment.
Bingo. Exactly. Right. So it's a psychological thing. So we're in the 4s. Now, when it comes to variable rate mortgages, anybody that got into a variable rate mortgage, which is tied to the Bank of Canada rate, the Bank of Canada will come down. And one of our leading economic advisors out of Toronto has stated, variable rates will go down incrementally. Like it'll go down by 0.25 every time the Bank of Canada meets. But at some point in time, they're going to make a large drop. There's like a 1% decrease.
Really?
So a lot of the big thinkers are figuring that by summer, it'll start. By the fall, we'll see variable rates drop down around 3.5%. Wow. So
by fall, okay.
So these are predictions. These are crystal ball predictions.
Of course, right.
Like we said, hey, look, the rates are going to continue to go down, but they'll always find something that will kind of stall it. Yeah. Like the U.S. Jobs report came out, the U.S. inflation rate came out, and it was higher than expected. Well, that kind of stalled the interest rates because it affected.
So that affects everything.
It affected the bond market in Canada, right? So instead of it going from 5.09 to 5.04, it just stayed at 5.09. When that report, now it's been about 2 weeks since that report came out, and the Canada inflation rate came out, and it was better than expected, so now rates are continuing to drop. Yeah. So you will get the little blips, but at the end of the day, it's always like a curve, right? It's, every 7 years it goes up, and then it goes back down. And if you look at any chart, if you were to Google interest rates from 1947 to now, you'll see that it just does this, like a wave, up and down, up and down.
Right. And there's so much to it. There's so much that none of us really know. Like everybody's just out there. We want rates to drop. We want rates to drop, but it just doesn't happen like that. From what you're saying, there's so much more at play for them to drop. Yeah. Like there's so many things that have to happen,
and we watch every morning. We're watching, we're checking economic outdates. We're checking, bond markets. We're checking the U.S. labor market. We're checking all these things because we want to know in advance what's going to happen.
Right, and these are all predictors. These are all indicators.
Yes.
So that's one thing that I've tried to wrap my head around, and this is a complex topic. But the bonds. How does the bonds again affect the interest rates?
So the bond market, the Canadian bond market, so it's tied to the federal government bond market. As bond rates go down, so do interest rates.
As bond rates go down, so do interest rates. And bonds, again, let's confirm bonds. So bonds are some type of borrowing against the government, isn't it?
That's right. You're borrowing money up against the government. You're buying a bond you're like buying a stock. It's almost like.
Right.
So and they're tied into all the economic markets around the world. So again, at the end of the day, as the bond market lowers, so does the rate. As the bond market goes up or the value of a bond goes up, the rates will go up.
So then that can kind of be an indicator for you. Like you said, you're checking the bond. So then you're going where the bond's going. If the bonds start going down, then is that going to be an indicator that possibly when the Bank of Canada meets? Because is it the Bank of Canada that dictates whether the interest rates are going to drop?
Bank of Canada indicates whether the Bank of Canada interest rates are going to drop, which means that's tied to all banking variable rate products. So it could be line of credit, could be your credit card, could be, right?
Okay.
So all of those like incremental costs.
I'm going to learn a lot here today.
So the Bank of Canada rate really does. So the Bank of Canada will look at all the economic factors. They'll look at productivity, GDP, they'll look at inflation, they'll look at jobs, they'll look at all these indicators in Canada and the U.S. before they make a decision. They also look at what the U.S. Fed is doing in regards to their overnight rate too. We call it an overnight rate, but they only meet every 6 weeks. Right?
Okay. So if you put 5% down, Brad, on a mortgage, if you actually do buy CMHC,
yes,
is the rate cheaper if you get CMHC or is it higher if you put 20% down? Because I've been hearing this.
Isn't it? From what I've heard, it's cheaper if you do the 5%, and then if you go full 20% down, you're actually paying a higher rate.
Is this true?
Okay, so the way that works is
this. No, I know. Yeah.
The answer is yes and no. Okay?
Of course.
So it really depends on the price of the house that you're buying.
Okay.
And it depends on the amount of down payment you put down. So if, for example, I buy a $600,000 house, right? And I want to put 5% down, that's $30,000, right? My CMHC insurance is going to cost me an additional 4%.
So you lose your down payment.
You lose you lose about 80% of your down payment. But having said that, that's also over 25 years. Remember that CMHC. So, and you get, because it's insured, because it has CMHC insurance, it's insured. You are getting the lowest possible interest rate. Why? If you put between 5 and 20% down, it can be insured, or it is an insured mortgage. I mean,
so
CMHC's
like 5 to 19.99.
Yeah.
99.
Yeah. Well, there's actually, we won't get into the weeds, but 20% can go either way. But at the end of the day, if you put 5 to 19.99% down, it's insured. You're going to get the lowest interest rate, right?
Right.
The more you put down, the lower the CMHC fee.
Oh, so you can get, if you put 30% down, you can still get CMHC if you want.
It can be insurable, yes.
Oh, okay.
Yes. So if you...
Is it like a risk thing for the bank? Is that why they give you a better rate?
Yeah.
So between 5 and 19.99% is insured. That means the bank's not taking on any risk. The CMHC insurance is there to cover in case the house gets foreclosed on, or in case the bank fails and they want to go and call the client's loan.
That's what I was going to say. So if the house is foreclosed, bank repo, whatever, whoever uses, whatever term you want to use, if it gets foreclosed or repoed, the bank's not responsible for it. Just to clarify that for anybody. So the CMHC kind of takes the reins on that, and the bank's free and clear of any debt.
For a certain period of time, yes.
So then CMHC is pretty well an insurance for the banks.
That's correct.
Okay.
So once you get over 20%, so let's assume you put 25% down. Well, it's not insured. Now, it can be insurable. You can have the bank, it can be insurable, which basically means the bank pays the insurance in the back end. And you'll get a little higher rate, but it won't be a real high rate. So if say, insured rate is 5.09, the insurable rate, meaning the bank's paid the insurance in the back end, you don't have to as a client, you might go from 509 to 524. Okay. If it's uninsured, in other words, you're not putting anything down, if you decide to go 30%, 25%, 30%, 35%, and you don't want it to be insured, then you are going to pay an even higher rate. But once you put 35% down, you've taken on the risk. You, the client, have taken on the risk. So you get the lowest possible rate. So your best bet when buying a house or budgeting is either make it insured between 5 and 19%.
Right.
Or put 35% down, you'll get the lowest possible rate.
35% down, that's a lot of money. You probably don't see that a lot, Brad?
Right. Well, I mean, it happens. I mean, people do divest themselves of big houses and they maybe want to downsize.
Right.
So they might make $200,000 and they're only maybe buying a $500,000 home.
Right.
I know that sounds like a lot of money, but at the end of the day, if they're putting 35% down, they're going to get the lowest possible rate.
Right.
And if it's also, if it's uninsured, it can go to 30 years.
Talking about insurance.
Oh, we can. Yeah. 30 years. I didn't know that.
If what? Sorry, say that again?
If you put more, if it's not insured, you can get a 30-year mortgage now. Yeah. I didn't know that.
Okay.
Do you think on that, sorry, Brandon.
No, it's all good. Go ahead.
On that 30 years, with the price of housing, by the end of this year, especially if rates come down, I think there's going to be, this is what I think, and take that with a grain of salt, but I think we're going to get into more and more bidding wars. They're going to go higher and higher. Now, if the prices keep going up and up and up, will the Bank of Canada step in and say, okay, we're going to do 35-year mortgages, or maybe even something crazy like 40-year mortgages to make it affordable for people?
So we are part of MPC, which is the Mortgage Professionals Canada, which is a nationwide organization, and we have lobbyists in Ottawa.
Okay.
Right? Okay. Like the sugar industry, I hate to say it. But so we have lobbyists in Ottawa, and we are lobbying for extended terms.
Oh, you are already?
We have been lobbying for years for getting rid of the stress test.
What's the
stress test? So if I buy a house, you buy a house for 5% down, and you qualify, and the interest rate we're going to give you is, say, 5%. We still have to qualify you at 7%, 2% over the qualified rate, because the government has built in that kind of buffer.
Is that because considering like legal fees and all this stuff, or they don't care about that?
That's just hedging against the rates going up.
Okay.
So the federal government has said anytime you do this, anytime you buy a house, you've got to qualify 2% over the rate you're going to give, or at least 5.25%.
So it's going to be hard for people to get it qualified if prices keep going up if they keep that stress test in.
Exactly. Right. So we're lobbying against the stress test. Now, the federal government has recently made a decision that if you have an insured mortgage and you're going to refinance it or you're going to transfer it, they're going to allow you not to use the stress test. Okay. So that's changed on the refinance market, but as far as the purchase market, nothing has changed yet. So yes, we are lobbying heavily for extended periods, 30 to 30, at least a 30-year for even an insured product. Whether the federal government will listen to us or not, it's hard to say, but they kind of pick and choose, right? We are lobbying on a bunch of different points, so all the time.
So the best thing for people, what do you think, Brandon? I mean, you could give me your opinion on this. If prices keep going up, which I think they're going to, if we can stretch the terms out and get rid of that stress test, it'll be a little easier for people to get homes.
I'd say so, yeah. So as long as the interest rates drop, I think the prices will go up. Right now, we're kind of seeing prices almost kind of level out a little bit, because we went through for 10 years in St. John from pretty well 2012 to 2002, or sorry, to 2022. If you look, or sorry, 2021, I guess it'd be 2021. The housing prices literally went up in the summer and they went down in the winter, and we were pretty well it was a flat line of housing prices for 10 years in St. John.
Yeah.
And everybody was tying their property value to the assessment value because it was so close for the longest time. These correlated for so long. Everybody's like, oh, it's only assessed at this, so that's the value. Now, over the pandemic, we've seen a huge spike in housing prices here in St. John, which has gone crazy over the last 2 years, right? Like we can all say. A little, like over the last few months, we've been seeing things kind of leveling out. So that massive spike stopped, and we're floating right around the average house price being like 280, 300,000, and it's kind of right around there, 320, 280, kind of floating around.
In just St. John.
Just St. John, absolutely. Yeah. I'm just talking about kind of like the St. John, almost New Brunswick area. If the interest rates go down, I think we're going to see another spike, almost like we had back in 2021.
I think
there's going to be do you disagree?
I disagree.
You do? Wow.
So, because even before this, you were saying you think the housing prices are going to be going up, though, right?
In certain areas.
In certain areas.
Like Quispam like what you were saying, what do you think by the end of this year an average price will be in Quispam?
Quispam, Ross say, is growing so quickly that we have people that are saying that the average housing price in Quispam could be 600.
600,000.
Could be 600. So
I love hearing that.
So, but that is a suburb that is outside of the city too,
right?
And but you also have higher end homes, more square footage on average, right? So, and also there's a little bit of attraction to the lower property taxes.
Absolutely.
Right. So if you're going to buy a $600,000 home, but your property taxes are going to be lower, then okay. So could it go up to 600? Who knows? But right now it's got to be in the valley. What is it? 410? Something like that?
Easy. Yeah.
Yeah, probably. Yeah. High
You're not
threes.
getting anything. It's minimum 400.
It's got to be at least 370, probably around 370 average. Probably even higher.
Probably a little higher.
Probably higher.
So, to your point, do you think that the housing prices are going to go up? I think in specific areas it might go up, but I think in urban centers, Mountain St. John, Fredericton, I think that what's going to end up happening is with the rates going down, the market's going to open. In other words, there are going to be more listings. There are going to be more houses because people are not scared to now.
Which we need.
We need, right? Yeah. So people are going to say, interest rates are in the 4% range or the high 4s. We can now sell our house and buy another house and get a mortgage and not worry about the high cost, because maybe the mortgage on the house that we're selling is COVID prices of 2.79 or 2.89.
Right.
So it's not as much sticker shock for them. So we'll have more houses on the market. So as well as I do, it's all supply and demand.
Right.
So if there's a lot of supply, the demand is not going to be as much for each individual property. I think the housing prices in urban centers will go up, but I think it'll be incremental to how much market is available.
And how much supply and demand is available.
Right.
Okay.
And I hope you're right, because I have a lot.
Now, so the issue with that, though, is like there's not enough homes being built right now. There's so many people moving here too, Brad. Like if we look at the population growth in New Brunswick over the last three years, we've seen almost 60 to 70,000 people come into New Brunswick. So the population back in like 2019, if you look at the census online, it was 775,000. That was in New Brunswick. And if you look at it now, we are well over 800,000. We're about like 830,000 people. They're pushing for like 1 million people.
Within like 3 years.
Within like 3 years. So there's so many people moving here. And a lot of it's coming from Ontario, as you know. A lot of people coming here from Ontario. And a lot of people looking at New Brunswick as a great spot to live because of the lifestyle. We have a slower lifestyle, not as many big cities, but then they're also looking at the house prices too. So we have some of the lowest average house prices per any province, province in the country. So that's the reason that I feel like if the interest rates drop, we're going to see even more people fluctuating. It's almost like New Brunswick has been put on the map in Canada. But I feel like a lot of people are kind of going to be jumping here. So like you said, the supply and demand issue, I feel like we don't have enough homes being built. I guess the only thing that could fix this situation is, like you said, more people being willing to sell.
And I hope Brad's right on that, because
I hope so too.
I have a lot of clients that would love to sell, but there's such a huge risk that they have nowhere to go.
Right.
And right?
I would say, we talk about, the influence of Ontario and British Columbia moving here. And yeah, I mean, it's huge. I mean, in 2020, beginning of 2020, if I had 30 files on my desk, I might have one from outside of the province. Now I have 30 files on my desk. At least 30% of them are from BC or Ontario.
That's
interesting.
Insane.
Yep.
But keep in mind, as housing prices have gone up, a lot of people in New Brunswick have been taken out of the house buying market because they can't afford it.
It's sad.
So
actually.
it's a matter of affordability. So I would say that, yes, we've still got that influx of people from outside of the province, bringing in cash offers, bringing in, high-paying jobs that they can transfer into New Brunswick. But it is at the unfortunately, the risk of the fact that at the mercy of the people in, say, New Brunswick, who their job income has not kept up with housing prices.
Right.
So you might have somebody that's working as a CSR or at, say, a call center, who maybe 2 years ago could afford a property, but now that property is out of their range. So now they have to do a little bit more planning. They've got to maybe involve somebody else in the mortgage in order to be able to afford that mortgage. So it's tougher for the local market.
Another thing that I think we're going to see a lot more of is people, almost like the European model of people moving in with families. So like, let's say like buying their grandparents' property, or like having properties sold within families. Do you see that happening even more right now? And do you foresee that kind of?
Yeah, that's happening a lot. We're seeing a lot of that. We're seeing, okay, we want to buy a place, we want to buy it, but we want to renovate it, put a granny suite in for our parents.
Right.
Or we want to buy something with an income suite so our parents can move in.
Yes.
So we're seeing a lot more
collect a little bit
of
of rent, something like that.
And do you think that's to do with the prices?
It's got a lot to do with the prices. It's got a lot to do with people downsizing.
What's the average income for somebody needs now? Like with the price of houses and the mortgage, and if you're in the city, water bills, taxes, insurance, groceries, car payments, like you must need at least a couple $100,000 to live okay,
depending on what the house price is. But yeah, I mean, you're right. When we go back to something we first talked about, what would you say a first-time home buyer needs to do? The first thing I would say is get a hold of a broker, sit down and plan.
Right.
Sit down. Okay, how much you bringing in? Yeah. Okay, let's factor in the water and sewage bills. There's $119 if you're in the city of St. John. Let's figure in your insurance cost. There's $80 a month to insure the house. Let's figure in, your gas, your food, all of that stuff. Now let's see what your income is. Yeah. So when we do an application, we do most of that. So we look at income versus debt. So we first start with the debt, because that's the one thing that will determine how much house you can get. So we look at your monthly income. We look at your child tax benefit. We can add that as income, usually. There are some caveats to that, but 90% of the time we can use that. We look at any other incremental income that you might have coming in. So, for example, your spouse, they use their income, or you have another source of income from a second job, which is becoming more and more predominant, I hate to say. So we look at the income. Then we look at the debt. And when we look at the debt, we look at what do you have for bills, like line of credit, credit card, car payment, those type of bills that show up on your credit report. Yeah. But also on the debt line, we're looking at What's your monthly property tax of the house you want to buy?
Right.
What's the mortgage payment plus the stress test of the mortgage that you want to buy?
Jeez, there's a
so
lot.
that's all added on to, and 100% and $100 for heat, usually $100 to $150 per heat per month, depending on the size of the house. So that's all the debt. So you got the income versus the debt, and you can't go any more than, depending on what your income or your credit score is, you can't go any higher than 42 or 44%.
So are you able to?
That's the income to debt ratio.
Yeah.
Are you able to help? Are you seeing now people kind of collaborating their debt, like unnecessary debt, with a mortgage maybe to help them out?
Can't do it as you purchase a property. You've got to pay it out first.
After you pay it out, and then you can take some equity out of your house to pay off like a credit card or something like that to help. Like,
if you refinance your house after the term, yes,
Yeah.
you can definitely get rid of consolidate debt.
Right.
What I tell people that are struggling with debt ratio is, hey, look, first and foremost, if you're planning ahead, get your credit cards down to zero. Get your lines of credit down as low as you possibly can. Don't go and buy that $85,000 pickup truck.
Right.
Until maybe after you buy your house.
Right.
If you're driving an old Ford Ranger, if you can make do with that, with a no car payment or a $200 a month car payment, by buying a car or truck with $1,000 a month car payment, it kills you right there. You can't.
Have you ever
do it.
seen people sign for the house, the purchase and sale, and then go out and get like a big, like say a Brick or Leon's credit card and put 10 grand down, and then lose the deal because of something like that?
I will tell the story, and I will not use any names
No.
protect the innocent.
Right.
It was a young fellow bought a house. He goes approved for the house. The house was going to close at the end of June, a couple of years ago. And I said, look, you've got your car payment, you got this. And we tell every client the same speech every time. We never miss. We always say the same thing. Don't go buy anything big before the house closes. Get the house closed. Then it's up to you whether or not you can afford anything. But you want to
quit your job.
We've tied up all of your credit on this house. We've tied up. We know that you can afford this house based on the current debt that you have. Do not buy anything.
Right.
Bank calls me a week before closing.
So all the deposits down.
Everything's down.
Everything's done.
We're ready. We're going to the lawyers.
Yeah.
The week before close, the bank calls me. We checked his credit again, which they have the right to do. They can do a soft hit on your credit right up until the day of close, really.
Okay.
He bought a Ford F-150 for $85,000
Oh my God. After you already
Talk
told this
about-
person to not.
with an $850 a month additional payment onto his
Talk
debt.
about the debt to income ratio.
We can't close this property with that debt.
And so you got to make this call to this person and say,
Hey,
terrible.
guess what?
did he lose his deposit?
Guess what? You bought a truck. Yeah. Remember we had that conversation about not buying a large item? Don't go to Leon's and buy your furniture yet. Don't go and buy a car. Yeah, well, my truck broke down, so I need a new truck. Yeah, okay, great. So here
Should've waited a week.
you've got two choices. You can either sleep in your truck for the next 5 years, or you can return the truck
Oh, okay. So he was able to return it and save it.
with a penalty. But yeah,
Yeah. Okay.
actually let him
interesting.
do that.
I had a client call me once, so we had the deal firm. His deposit was down, and he was miserable at his job. This was a fellow who was able to get another job really quick in his line of work. He can line up work pretty fast, but he said, Brandon, I can't stand what I'm doing right now, and I want to quit. Is that going to affect the closing? I said, don't you friggin' dare.
no.
Yeah.
Don't you dare
Wait
quit
till
that job.
after.
That'll wreck everything. They could double check it. He's like, can they? And anyway, so we held on right until closing. And I think like the day after closing, he went in and said, I'm done. And then he was employed a week later. Like,
Yeah.
it's not like he just quit. And
He wouldn't have got the mortgage. Look, he might have got the mortgage. He might not have. Like you said, they might not double check.
probably not have, though, eh?
What,
Like,
do they
if
know? Do they always
if would've
double check
che-
before it closes?
Right. Do they always double
Uh,
check? Or is it just a roll the dice?
100% of the time they're going to check.
Right. Right.
I
100%
would. If I'm lending
Of
somebody
course.
$300,000, I'm like, listen, am I
course.
going to.
During COVID, there was so much migration from Ontario to New Brunswick and Nova Scotia and PEI that people were getting approved in Ontario, putting down their deposit, quitting their job, moving to New Brunswick in time to close the house. Banks have clamped down on that because of so much fraud, because people were moving to New Brunswick, no jobs, no way to pay for their mortgage.
Right.
So what the standard practice is, and I mean, it's common knowledge, is that when you send us a job letter. We confirm that job letter. We confirm the income with your T4s and your notice of assessments. We confirm that you're working there. We've got a job letter makes sense.
Yep.
The lender will contact verbally, will call your employer absolutely up to a day before a house closes. And they will confirm everything that's on that letter. And if you can't confirm everything that's on that letter, the deal's dead. So I have had a situation last month where the employer put on the letter, person was working 40 hours a week, but when it came to the verbal, the employer said, well, yeah, we use them when we need them.
Ooh, yeah.
And it killed the deal.
Wow.
It killed the deal. So can't stress enough. If you're going to give us an employment letter, make sure it's accurate.
Right.
And make sure that your employer, your employer will be called.
Especially today, everything's like double, triple, quadruple check now with like you just said.
Oh, yeah.
There's so much mortgage fraud in this country that we have to make sure that we follow the rules.
And here, there's a couple scenarios. I don't know if this ever happened to you, Brandon. There's out west, Ontario, wherever. People were writing offers on homes, some agents were, and not knowing, not doing their due diligence and saying, oh, it's all cash offer. And then you're getting a call for an appraisal because they're financing it, right? So that a lot of that was going on too.
Yep.
So now I'm like, okay, I make it clear to anyone who's writing an offer, if it's cash, I want a statement or a letter with the offer saying they actually have the
confirmation
funds.
of funds.
Some sort of confirmation of funds.
Yeah.
Confirmation of funds
with
from a bank.
the offer.
Yeah.
Because I've been burned before, and then the appraisal didn't come back where they wanted it to, and we couldn't get the deal together,
Right.
and it wasn't cash.
Right.
It was some, what do they call it? Private money or something.
Oh, that's terrible. Yeah,
Yeah,
I've had
like-
some people from Ontario
What's
call
it
me and ask
called?
about that. It's called OPM.
OPM.
Other people's money.
You ever
Yeah.
hear that
I've
term?
had some people call me and go, yeah, we're planning on using OPM, so we want to put this deal together. And then I said, so sorry, what are you planning on
it's
doing?
very
And then
common.
they said, other people's money. Have you never heard of that? We just watched a video online about it. And they said, geez, no, tell me more. I was like, geez, this sounds pretty interesting. I'd like to use other people's money for everything I buy.
But it's quite common in Ontario.
Just kind of making jokes, right?
Like
Yeah.
it's very
No.
common. Like
I think there is. So, is that wholesaling? Is that wholesaling homes when you go out and put deals together, and then you actually find somebody who's willing to almost pay more for that deal, and then you make the commission on it? I don't think that's legal, is it?
No.
Yeah, that's like
There you go. No.
yeah, that's not legal at all.
No, I mean, there's a whole bunch of stuff going on in Ontario right now where people are doing promissory notes and people are doing, we're saying, okay, we're going to buy this property for you, but we're going to charge you no interest, but we're going to take over the property. And like there are massive issues in Ontario.
What have you heard about the OPM, about other people's money?
The good thing is we haven't heard anything about it because
You haven't heard about that?
well, we know about it,
Yeah.
but we will not engage.
Okay. Yeah. Absolutely.
At
Right.
all.
Yeah. No.
We
exactly.
don't want
Just-
to know anything about
a lot
that.
of flippers
Yeah.
do that. So they have private investors, and they buy the house. They actually buy the house cash, and there's
Yeah.
like a 10% interest fee when they know they're going to flip. And they know they're going to get their money back, and they have to pay this investor like 10% back on the end. Like
Yeah.
that's what a lot of
Well,
flippers
private investors.
private
I mean,
investors.
yeah.
There's a lot of that.
Well,
which
some
is-
of it's legal, some of it's not
that,
legal.
I think
Yeah.
that's like there's no mortgage involved.
Right.
Like it's like a
If there's no
cash
mortgage
deal.
involved, that's
Right.
loaning.
Right.
Yeah. But if you're looking at investing, like, we do have private lenders that are available to us, but they again have to be vetted through FCMB and they've got to follow rules and
And
regulations.
the interest rates would be a lot higher with these.
Oh, yeah.
If somebody needs a private lender, because there's obviously a reason they get some bad credit issues or something like that. So
Not always.
No.
No,
Okay.
not always. You
Why
might be
would go
going
that
through.
route then?
You might be going through a marital breakup, and you don't want to go to a regular lender right now. You might be going through.
Okay.
You might be going through a bankruptcy, or you might be. You might be just need money short term, and you don't want to tie up your credit. So, I mean, I've got a guy who owns 2 houses. He's got perfect credit. He took out a private mortgage for a build.
Right.
To build a house, right? Eventually, he'll sell this house and that house. He'll pay the high interest rates and the fees for the private
So
money.
you're not locked
Okay.
in. There's
No,
no
Okay.
term.
it's always open.
So if they sell the house, they pay the
Yeah.
private take the. So yeah, that makes it easier, honestly.
If I want to buy land, if I've got 4 houses and I want to buy a piece of land, I'll probably go to a private lender for a couple of months.
and you
until
have access to those
because it's
Brad? Like,
easier.
if any clients needed
Yep.
wanted to invest.
And then that's because it's easier. So
it's easier, it's quicker, and it's if you have to make a snap decision, right?
That makes sense. Then.
It is certainly much easier than going
for people that are kind of in that situation, like you said, that know that they're going to be turning a profit on it, and are looking to make that money. And
but there are also tax implications to flipping houses too, right? So you've got to remember, you got a capital gains tax.
Yeah.
You got to make sure that you keep the house for at least 12 months. You know,
do you know? I know you're not an accountant, but do you know much about, like, there's so many different opinions on capital gains. It's cheaper if you're incorporated, and it's cheaper if you're paying capital gains on
capital gains is a personal tax, so it depends on how much you're claiming as personal income.
Right. So I just sold a property of my own that was a flip in my company, and I want to say that my accountant said in the company you'll be taxed 13% capital gains at the
right. You've got a corporate. There's a corporate tax. It's not a capital gains tax, but it's a corporate
tax.
Corporate profit tax is what they call it. Yeah.
So that's what you get. It's a little cheaper than a personal.
Yes.
Okay.
Yes.
That's what I was
in your incorporated company, it's going to be cheaper, but it's not technically capital gains. It's
It's just You just
Yeah.
And it's so ridiculous. Like, why would the government? Why do they need? How do they have the right to get money from the property that you own? Like capital gains. If you live there a year, now you don't have to pay it.
But
it's in your name.
Yeah, what they're doing is they're trying to stop speculation. They're trying to stop people from Ontario coming in, buying up properties, and then renovating them, and then turning around and selling them for triple the price to make triple the profit.
Right.
And again, if it becomes an industry, and if it becomes an industry, it becomes profitable. And if it becomes profitable, then what you end up having is you have people that don't necessarily follow the law come in. So we're talking about organized crime coming in, buying properties, buying stakes of properties, and turning them around, flipping them for profit that they're going to hide and use for like drug use or illegal activity.
Yeah.
So this is why they have the capital gains tax in place.
Okay.
Yeah.
So one thing too, I don't know if there's any other provinces that do it. Drives me crazy. So like rents are high for people and it sucks, but there's a lot of things like if you really sit down and look at the numbers on rental properties for owners that have bought in the last few years, the numbers are quite high because the rates are high. In New Brunswick, it's double property tax, which to me was supposed to be gone, but they never get rid of it, which is crazy. Double water and sewage.
Send a petition to Ernie Steves, Finance Minister, Province of New Brunswick.
It's so foolish. Like, so you get double water and sewage, double property tax. So if the tax is $4,000, it's $8,000. So, and the mortgages are higher. So all these, this is why a lot of the rents are up as well, because of all these numbers. It's all about numbers. So I wish like that. I could understand maybe if somebody bought a property out in BC and was renting it here and lived out there. But for people that own properties in New Brunswick, I personally, the double tax is crazy.
So they have a different rule in every province too. In Nova Scotia, if you're living in the property, then you're not going to be paying that additional property. You pay 5%. Was it 5% more? It's 5 times more in Nova Scotia.
Five
times more if you're not living in the property.
Wow.
Yeah.
It's more than double?
Yeah.
But their taxes can't be as high as ours.
It's depending on where you live, right? So every province is a little bit different. In New Brunswick, yes, you pay the owner-occupied tax rate or the non-owner-occupied tax rate if you're not living in the property. The provincial government did say 2 years ago that they were going to start to drop that over a period of time. I'm not sure what's happened with that because none of it's changed. It's still where it was.
Right.
So
and it was going to be dropped incrementally.
It was supposed to be dropped incrementally over a 3-year period.
Yeah.
That's gone off the shelf.
Yeah.
I talked to your MLA, send a petition out to the finance minister. What's going on? Because it is hurting the economy. It's also hurting renters.
That's what I mean.
Right?
No.
Right.
But it's more tax money for the province. So it's a tax grab, right?
That's all it is.
And if they're just basically backtracking from what they promised.
Yeah.
Something that people ask me quite a bit is like the first-time home buyer initiative.
Right.
So what is your thought on that, Brad? So that's the one where I think the government, what do? They give they'll pitch in like 10%.
Okay, so there's three different programs.
Right. So the one that I'm thinking of, and the one that I kind of want your opinion on, because I don't really recommend people to normally do it, is the one where they give like 10% towards the mortgage, but then when you go to sell it, you need to give them 10% of the equity.
So
what was that?
Okay, so that is called the first time. So it's been in place for 2 years now.
Yeah.
It's called the First Time Home Buyers Incentive Program.
Right. Yes.
You put 5% down. The government will match your 5% at 0% interest.
5%. Thank you. Okay.
So you've got to put your own 5% in. The government will match the other 5%. Here is the rub. It sounds great on paper.
Right.
It means you're getting a 90.
Nothing's great. The government
great.
gives.
Right.
I'll tell you that for starters.
Right. There's a reason. There's a reason they're doing it.
If you bought the house for $100,000 and you sell it for $300,000, the government wants 5% back of the $300,000
After it's sold.
After it's sold.
Right.
What's the point?
Well,
Number
the point's
two,
to help people get into the house, but then they're pretty well losing the equity when on the back end.
you can't refinance without the government's permission. If you get it appraised and they
gross.
don't agree with the appraisal, they can order their own appraisal and you pay for it.
Oh.
You can't sell it without their permission.
Okay, I'm glad we're talking about this.
You can't sell it without them agreeing to the price. There are so many caveats to that program.
Yeah.
It has been used last time in September when I was in Toronto. One of our major brokers in Toronto said, "I can count 6 times in the last 2 years it's been used," and he's in Toronto. And he said it was only for condos where it would cost you $1.2 million and you need $200,000 down payment because
And it kind of makes sense in that scenario.
It kind of makes sense in that scenario.
For anyone here?
Yeah.
No.
Also, the
A lot
client
of people ask about that, and I'm like, it's not as good as it sounds.
and the client has to fill out the application, and it's 14 pages long, and it has to be approved by the lender, and it slows down the process. But at the end of the day, it's really, unless you're comfortable with the government being in your bedroom, I wouldn't do it.
And that's the same too. I think, like, look, there's different opinions on everything, and that's just why we kind of do this. We share our own. I had a buddy last year. He's like, he's just a blue collar guy working. He goes, "Oh yeah, I invested 20,000 in RSPs, for the future." And like, he's not taxed bad. He's not self-employed. I'm like, why would you do that? He's like, "Well, what do you mean? It's an investment." I said, "Well, you just gave them 10 grand. He goes, "What do you mean?" I'm like, "You already had the taxes paid on that 20,000. Now you put it in RSPs. You go to take that out, half of it's gone in taxes."
Unless you're using it for a down payment on a house.
Yeah, but he already did that.
Okay.
He already had his house. Right? It's gone. So and that's another thing, RSPs, personally, I don't like them myself. I mean, there's good things about them to bring your income down for self-employed people and stuff, but like, I just find anything the government puts in place is to help them make money.
So you're taking after-tax money, you're putting it in an RSP.
Yeah.
And then when you withdraw it, you're going to be taxed at the
Taxed
rate
again.
that you're taxed again. So yes, you're right. In that situation, yeah, it's absolutely
makes
bad.
it- yeah.
But if the RSPs are being taken out of your bank before, if
Right.
you're
Like
taken
if
out
you're
of your
working for
pay,
somebody and they're
Right,
paying into
okay.
it. Yeah, that's a great
before you
addition.
pay taxes, then it's a win-win.
Right. Yeah, I
Right.
used to work at the railway, and they would we'd have 5% taken out, and they'd match 5. So it was great, right? At least it's a little something we're investing. But I just mean in that situation, like, it just didn't make sense. Like, why would you do that?
Let's talk a little bit. I mean, you guys had brought it up, and let's finish it up. What are the incentives for new first-time home buyers as far as what's out there, what's available?
Yeah.
So we talked about the first-time home buyers incentive program, and we pretty well all agreed.
Yeah,
the
you
three
said
of
there's a
us.
few options.
It's So you've got the option to take money out of your RSPs. You can take up to $35,000 out of your RSP.
35,000.
Yeah. So it changes every year. So it's $35,000
Okay.
that you can take out for down payment out of your RSP and it's repaid through taxes over the next 15 years.
15 years, okay.
Yeah, 0% interest. So that's a win.
That's a great
That's a
win.
win,
Yeah,
100%.
it's a great. The best one is the FHSA, First Time Home Buyer Savings Account, which now all the banks now have, and you're allowed to contribute $8,000 per person per year. So I had a couple. They wanted to get they wanted to have their FHSA set up. So we set it up in November. He put $8,000 in. She put $8,000 in November. Then in January, he put another $8,000 in, and she put another $8,000 because it was a new year. So now they have $32,000 sitting in their FHSA. They can take that money and get a $32,000 tax credit next year.
Jeez.
Or $16,000 this year, $16,000 next year.
Oh, really?
Right? So, and the big thing, it's the same as the RSP plan, except that it doesn't have to be in the account for 90 days. It can be in there for one day. You could transfer it from your savings account into the FHSA and then pay your deposit to your realtor and there's your tax. There's your tax deduction.
I didn't know about that one. That's wicked.
That either.
Okay.
So that's a win.
How long has that been around?
And what's that called again?
Barely new. It's FHSA, First Time Homebuyers Savings Account.
Okay.
First time
You do it through a
homebuyers
chartered,
savings.
and we usually, as brokers, we walk you through it.
Right.
Right. We'll show you how to maximize your credits.
Okay.
Yeah, if
I
you
like
have
that.
the money sitting in your bank for a down payment, you should. That's a great. Why wouldn't you do that?
And this being tax season, don't forget that whenever you've moved and you've moved closer to your work or you've moved for work, there are on your tax returns, go to Tally Tax or go to Brand Tax or whomever you get your taxes done. Make sure that they tick off all of the tax incentives to move because you moved for your new home and new job.
Okay.
Right.
Okay.
So there are incentives on your T1 tax return too.
Wow.
Wicked.
Jeez, this has been good.
Wicked.
This has been this was a good podcast. We had fun. We should probably wrap it up because you got to go to appointment. I got to meet my marketing team.
Yep. Brad, thank you very much.
This is awesome. Brad, has anybody looking for a mortgage? You need a broker. Brad Donnelly, top mortgage broker with Premier. Brandon and I are so pumped to have this one.
SJ Mortgage Guy.
SJ Mortgage.
That's your.
You can find him on TikTok.
He's on TikTok.
He's on TikTok. He's on all the social media platforms. We'll put links to it. We'll put links to you below too in the video.
Yeah.
So, Brad, thank you so much, and
Thanks,
maybe we could do this again in a little bit too.
Yes.
Kind of get an update, maybe coming into the summer once hopefully the rates drop.
Absolutely. We could talk about all kinds of stuff.
Exactly. Wicked.
And
wicked.
don't forget to, if you guys like this, don't forget to hit like, subscribe, and reach out to myself, Brandon, or Brad. If you guys need absolutely anything, we got you.
Wicked. Cool.
All right.
Thank you.
Thanks, guys.